Okay, remember I show you this equation at the beginning of this chapter. The cost of goods sold is the difference between the sum of beginning balance of inventory purchase. The both actually is the goods available for sale. If we subtract ending balance of inventory, the difference is cost of goods sold. We are going to use this equation to determine both cost of goods sold, which is reported in the income statement as an expense, and ending balance of inventory, which is reported as an asset in the balance sheet. Since beginning balance inventory is always given because it was a result from last accounting periods, and we just learned how to account for the net purchase, including factors like freight-in costs, purchase discount, purchase return, all these factors. Finally, we know how to calculate net purchase. Then the next topic is how we determine the amount of cost of goods sold and the ending balance of inventory. This is the topic of inventory cost flow. Before we start, let me just briefly introduce this example regarding a Converse company. We are given the dates of the transactions, number of units, unit cost, and total cost. The total cost is actually the units multiply the unit costs. First, we're given the beginning balance, number of units, unit cost, and the product of both is the total cost. The total cost of inventory was 22,000 in the beginning. There are three purchases: January 17th, March 22, October 15. Each purchase, the volume, and the purchase cost for each. The total cost of each purchase. The first purchase, 6,000, is result from 1,000 units and $6 per unit. The second one was a product of 3,000 units, $7 per unit. The third one is 3,000 units, $7.50 per unit. So the sum of the beginning balance of inventory plus the three purchases, 71,500, is the total goods available for sale. Total number of units was 11,000. And also, this is a assumed number. The unit cost keep increasing. This assumption is set on purpose. There are also three sales. First one on January 10th, April 15th, second one, the last one November 20. The units sold 2,000, 1,500, 3,000. Total units sold was 6,500. Since the units are given, we can use a formula. How many units were still available by the end of 2024? The beginning balance units 4,000. The total purchase 7,000. So total goods available for sale in units was 11,000. And the sales units sold 6,500. So what's the ending balance of inventory in units? You can easily get it is 4,500. But that's not the answer we need. We need the dollar amount. Okay, so the dollar amount relies on which inventory are sold, which inventory was not sold in the book. Since the price, the cost of inventory differ across different batches of purchase. So actually, the cost flow assumption matters in determining the value of cost of goods sold and ending balance of inventory. Similar to the prior slides I introduced, it's a summary. 11,000 units, 6,500 was sold, so 4,500 was left. So this is a distribution of total number of units sold. Since the total value of goods available for sale is available, question is, what's the cost of goods sold and what's ending balance of inventory? We know a number of units, but we don't know the unit price because unit price vary here. And 71,500 it comes from here. It is sum of this one and these three. Yeah, the summary actually sum these three. That's 49,500. The first one, cost flow assumption, is specific identification methods. This method refers to matching each unit sold during the period or each unit on hand at the end of the period with its actual cost. In other words, we can track the specific units either sold or unsold and its costs. This method is usually used for the customized and expensive products. For example, the jewelry, racing cars. So these are customized products. And the volume also is very low. So it is easy to apply to the specific identification methods. But for mass production, mass sales, usually this method is very costly and time consuming. Even we have technology. Remember, we can use a barcode to track each product and its price information. But it's still very costly methods. A commonly used cost flow assumption here are three. Average, first in, first out. We use FIFO as the abbreviation. Last in, first out, LIFO. The assumption for average is very simple. We just calculate average. Just you apply the average to the cost of inventory either sold or unsold. For this one, we use average. FIFO, we just assume the first purchase inventory will be sold first. Remember, the inventory, the purchased in the order, this is the first purchase, second, third, last purchase. So when the inventories are sold, total number of units 6,500 were sold, we assume they are sold in the order 1, 2, 3, 4. Conversely, LIFO is just in different direction. We assume the inventory are sold in this order. Last in, first out. The last purchase on October 15 will be considered first sold. Then March 22, January 17th. There's more sold January 1st, the beginning balance of inventory. And the company can now sell more than 11,000. That's the maximum number of units to be sold. Another factor when we apply the cost flow assumption is the inventory system. Remember, the periodic and the perpetual inventory system. And we're going to integrate the two different accounting systems and their application to different cost flow assumptions. This will make it more interesting, but also complicated. Let me show you their difference. First, we assume we are using the periodic inventory system. Since the inventory account is updated once at the end of each accounting period, we apply cost flow assumption where we have all the information because periodic inventory system. So we have the three purchase information, the beginning balance of inventory, then we can calculate the average, $6.50. So total goods available for sale is 71,500. This is same for every cost follow assumptions, divided by total number of units available for sale. So the average cost is $6.50. So when we calculate the ending balance of inventory, we just use this average cost multiply number of units that are left, which are unsold. The inventory that are unsold was 4,500. Units sold 6,500. We just multiply them by $6.50. Then ending balance of inventory is 29,250. The difference of these two is cost of goods sold. We only have one average. The reason is because periodic inventory system. The next is perpetual inventory system. Under perpetual inventory system, we update inventory accounts continuously. If there is a sales or inventory are out, we only have the information available before the sales. We do not have all the information. Okay, the purchase after the sales, we cannot use that. That's the difference between perpetual and the periodic inventory system. Let's take a look. We know the beginning balance inventory was 4,000 units, $5.50. Total value 22,000. So this is a balance. The first inventory sold was on January 10th. When this inventory was sold, we are going to account for the cost of goods sold. So on this date, we do not have information about the purchase on January 17th, March 22, October 15. We also don't have information about the sales on April 15th and November 20. We only have the information of beginning balance inventory on January 10th. In this case, we can only use $5.50 as average. Since inventory 2,000 was sold, we multiply the average based on available information. That's 11,000. Beginning balance 22,000, 11,000 out, so ending balance 11,000. Then there's a first purchase on January 17th. This purchase is 1,000 units, $6, so $6,000 value. After this purchase, the balance of inventory now is 3,000 units. Remember, 2,000 left, 1,000 purchase. Now total 3,000 units. And the average is calculated using 11,000, which was balance after the first sales, plus the value of the first purchase, that's 17,000, divided by the total number of units, 3,000. So average $5.667 per unit. One more purchase. This is another purchase, 3,000 units, $7 per unit. Total value 21. After this purchase, the value of inventory increased by 21, resulting in 38. The number of units increased from 3,000 units to 6,000 units because the new purchase is 3,000. Then we can calculate using the 38,000 divided by total number of units, 6,000. So on average, it's $6.333 per unit. Why the average increase? The reason is the purchase is $7 per unit, which is more expensive than the prior units. Then we have the second sales. Okay, the second sales is based on average available so far. So 1,500 units out, we multiply 6.333. So the total value of inventory sold 9,500. So we will reduce balance of inventory by 9,500. So it will result in 28,500. So far, the average was still 6.333. The number of units reduced from 6,000 to 4,500 because there was 1,500 out. Next, another purchase. This purchase increased the number of units from 4,500 to 7,500 because 3,000 units. And this purchase is more expensive than last one. We can expect the unit cost will be greater. How we calculate? First, we update the balance from last sales plus the new purchase 22,500 here. Then the total goods available for sale now is 51,000. 51,000 divided by total number of units 7,500. So the average is $6.80. Last but not the least is last sales. Their sales is 3,000 units, and we use the average available. So the inventory value sold was 2,400. After these sales, the number of units reduced from 7,500 to 4,500 because there was 3,000 units out. And the value of inventory sold 2,400 will be deducted from the balance. Finally, ending balance of inventory 30,600. And the cost of goods sold is determined by the sum of these three. For three different sales, we use three different average. This method is also called moving average methods because the average of the inventory keep changing because of the purchase. So different from the periodic inventory system, which just use a one average based on all the available information. Perpetual inventory system is different. And when we account for the cost of sales, we only use the information available on this day when the sales happens.